Good morning. You are watching live daily market outlook for Wednesday, 22nd of February 2012, prepared by Windsor Brokers. The initial optimism after yesterday's key event, Eurozone's sealing the Greek deal about second bailout of 130 billion euros, it seems to be fading as the single currencies failed actually to benefit more from this, and it seems that most of the gains prior to making a deal were priced out into the optimism, and the single currency is now struggling, although holding above some important supports. It's still below the key levels at 133 and 133.20, break of which is required to resume the short-term uptrend of the euro against the US dollar. Basically, the investors are concerned about further steps and implementation actually of the current deal. As from news this morning, the haircut of from initial 50% and then 70% was finalized at 74% that banks and private investors are going to lose in their Greek bonds after they matured in the beginning of March of 2012. Also, the austerity plan, quite tough for Greece, makes a lot of question marks. Is it going to be, is the Greece going to be able to implement all the rules they accepted in order to get the money? However, from the other side, the sterling remains under pressure, while dollar is against Japanese yen heading higher and hitting fresh highs this morning, break above a significant barrier of 80 level is signaling further extension and further recovery of the dollar yen, which is for a benefit of Japanese economy, as too strong yen was actually harming the economy. And despite three interventions in 2011, this Japanese currency continued to strengthen and hit last year's record low at 75.56. Gold is the top winner of among the instruments yesterday and today, as it broke some critical levels, barriers, and broke out actually of the recent congestion, and hitting levels just ahead of our next target, 1763. Also, the top performer is the crude oil, as current uncertainty about Iran is pushing the oil prices higher, with the levels above $106 per barrel seen in the late hours of yesterday. The high was 106.46 for the NYMEX April contracts, as Iran is failing now to find the new buyers of the oil in the Far East, in Asia, as well as with India, that was the number two consumer of the Iranian oil, as US yesterday agreed with Japan and also put limits on China, that asking to reduce the oil imports from Iran due to the sanctions imposed by US and the Eurozone to Iran. Earlier this week, Iran already cut supplying with its oil UK and France, with some more European countries to come, as the Eurozone imposed the sanctions on the Iranian oil. A brief look on today's calendar. The German flash manufacturing PMI is due in at 8:30 GMT, so in approximately 15 minutes. Forecast is higher than the previous release of 51.6 is today's forecast for manufacturing. Services PMI is forecasted at 53.8 compared to 53.7 of the previous release. Eurozone flash manufacturing PMI is due at 9 o'clock GMT, and 49.4 forecast for today, better than 48.8, higher than 48.8 previous release, while flash services PMI for Eurozone at the same time consensus 50.7 versus the previous release at 50.4. The Bank of England MPC's meeting minutes are due at 9:30 GMT, and unchanged the voting scheme of 009 is forecasted for today compared to the previous meetings, where it was the same type of voting at 009. From Eurozone at 10 o'clock GMT, industrial new orders monthly release increased by 0.6% is forecasted for today compared to minus 1.2% of the previous month. And across the ocean, existing home sales from US due at 1500 GMT. Another increase of sales is forecasted for today to 4.66 million units compared to 4.61 million units of the previous month release. Now, quick look at the markets to see the latest movements in the currencies and the commodities, starting with the euro. As we can see, the hourly structure shows the pair entrenched within the narrow range and in the directionless trading, as the studies are rather neutral at this point. Yesterday's high at 132.92, post-Greek deal high, when the pair rallied higher of 131.87, low of yesterday's Asian session, stays intact for now. As I mentioned earlier, the initial optimism is slightly fading, and the investors are not yet fully convinced about strength of the single currency, so they're rather staying neutral at this point. On the downside, we have initial support at 132.10, 132.00. That offers actually the strong support, and holding above here, where is also the 20 days moving average shown on the 4-hour chart. Holding above here keeps this neutral mode in play. That is also limited on the upside by 132.92 and a more significant level at 133 and 133.20. The pair is still struggling to clear the 90 days moving average that currently stands at 132.66, and basically is capping the recent price action. However, break above the triangle yesterday still holds gains above the broken triangle upper barrier, and this keeps some positive tone in play for possible further attack higher. The daily studies are still pointing higher, and the possibility exists for a test of 133.20, which is required to resume the short-term uptrend from 126.22. Back to the short-term outlook, loss of 132.00, 131.87 lows is expected to trigger further easing of the pair and the further reversal of the latest rally from 129.73 last week's low, with the 38.2 retracement level standing at 131.70. That would be initial target in case of a break below 132, 131.90. And then we have 50% at 131.33, and the low of congestion of 17th of February at 131.15, ahead of 130.95, the 61.8% Fibonacci retracement. Basically, loss of 131.70-50 zone would signal top at temporary top at 132.92, and likely open way for further raising, with the break below 131 to confirm and refocus 129.73 low of 16th of February 2012. The British pound is in the near-term down move of 158.80 zone, the previous highs of 1st and 9th of February. That proved to be strong barrier for now, as the last week's strong rally from a double bottom at 156.50 zone failed to clear this level. This was the last barrier ahead of our key resistance at 159.26, and also 200 days moving average currently at 159.09. That is limiting the upside for now, keeping the pair still in the larger picture on the downtrend from 161.64 2011 high. On the downside, the pair extended losses so far to 157.62. That marks approximately 50% Fibonacci retracement of the entire move from 156.54 up to 58.80. 157.62, slightly below 50%, with the corrective mild correction higher being capped at levels around 158, and the fresh weakness is now underway. Negative hourly studies keep the focus at the downside, with loss of initial support at 157.62 to open next. A strong barrier, Fibonacci 61.8 at 157.40, below which basically there is nothing. 57.40 and 157.35 is the high of 15th of February, below which basically there is nothing until the double bottom at 156.54 and 156.43 second and 14th and 16th February lows, and that would confirm the top of lower top at 158.80 and allow for a fresh leg lower, and also keep the 159.26 intact in the short term. Dollar yen is in strong uptrend after 2 days consolidation of 79.88 previous high. This morning surge through 80.00 barrier now looks for a test of more significant 80.23, better seen on the hourly, on the weekly chart. This is the high of 31st of July 2011 and the low of 31st of October 2012 breakpoint, and also the medium-term range ceiling, above which is to signal basing attempt and allow for a stronger correction of the long-term downtrend from the latest lower top at 124.14 first of June 2007 high. So this would signal a stronger recovery of the pair. A clearance of 55 days moving average will open, and the clearance of 80.23 would open a way for test of next dynamic barrier at 81.17. That marks a 90 days simple moving average on the weekly chart, and that will be the next obstacle ahead of 81.46 high of 3rd of July 2011, and the next barrier at 82.20 highs of May 2011. On the downside, immediate support lies of yesterday's consolidation floor at 79.61 and 79.50 as the previous peak, where is also 20 days moving average currently at 79.59, and is expected to contain any corrective dips in order to resume the gains, as the hourly and 4-hour studies are still quite overstretched, but yet no any reversal signals from the technicals for now. Dollar Swiss stays stuck within 90.80 and 91.50 range, as the pair lost traction after failing to break 93 barrier and extended the losses below the previous range at 91.00 to 90.80. This is the high of yesterday, fresh low of yesterday. A brief consolidation yesterday was capped by initial resistance at 91.50, with the fresh weakness now underway, looking for test of 91.00, 90.87. However, at this point, near-term structure is neutral, and the pair is in directionless mode. As long as 91.50 on the upside and 90.80 on the downside hold the price action. The wider picture shows more negative outlook and keeps the downside for now favored, as long as 92.00 90 days moving average caps the upside and keeps the downside, as I said, favored, with further extension of the downtrend from 93 high of 9th of January to possibly open way for test of round figure support at 90.00 and the 61.8 Fibonacci retracement of October-January ascend at 89.55. On the broader picture, only break above 93 and the 93.09, currently 55 days moving average, is to improve the short-term structure and possibly refocus higher levels and keep the sideline immediate risk of the further extension to the downside. Until then, the downside remains in focus with the levels previously mentioned to be tested in case of a break of the current range floor at 91.00 and 90.80. Quick look at the gold, as the yellow metal initially broke the narrower range ceiling at 1737. Broke our initial target at 1747, Fibonacci extension 61.4. Hit the Fibonacci extension at 100% at 1760, just ahead of our next very significant barrier at 1763, high of 3rd of February, and also high of 2nd of December 2011, and this is actually the key barrier, as 61.8% Fibonacci retracement stands slightly above this retracement of the broader downtrend from the record high at 1920 down to 1522, low of 29th of December 2011, and the break here is to refocus levels at 1800 highs of November 2011. As the main bear trend line of 1920 has been taken, the main obstacle now comes at 1763-65 zone, where it's previous high in the 61.8 Fibonacci retracement, and 1800. On the downside, the strong support is at 1700 zone, 1705 previous lows and double bottom, with the clear break above 1763 to confirm the double bottom and open way for a further extension higher. The studies on the daily outlook are still in the positive territory and keep the upside favored. The crude oil is in the steady rally after breaking initial barriers at 103.35, 103.70, hitting levels at above 106 so far, 106.46 yesterday's high, and a likely opening way, as there is no physical barriers at this point, opening way towards towards the highs of 2011, May 2011 at 114.80. The latest rally has also cleared 76.4 Fibonacci retracement of the entire down move from 114.80 down to 74.94, and keeps the upside in focus. This is mainly supported by current negative outlook in the world's oil market, as Iran coming under strict sanctions and reducing the supply towards the Europe and the Asia keeps the oil prices skyrocketing. Good luck.